So hopefully you can see that. Just let me put it in full screen. Okay, so as Rudiger mentioned, I have quite diverse research interests, but for this conference, I thought that it might be interesting to talk to you about some work that we've been doing at LSE over the last 5 years or so to try to measure and track what big corporations are doing on climate change. And many of these big corporations are energy companies. So let me start with the question of why are big corporations so much under the spotlight on climate change at the moment? Well, I can think of at least 3 reasons for that. So firstly, many of the biggest entities that emit greenhouse gases are corporations. And here what I'm showing you is some well-known research by Rick Heady of the Climate Accountability Institute. He published a paper in the journal Climatic Change in 2014, where he tried to work out what is the share of global industrial greenhouse gas emissions since the beginning of the Industrial Revolution that is attributed to the largest corporations? And what he found, what he calculated, is that around 2/3 of cumulative greenhouse gas emissions from industry since 1750 are attributable to just 90 fossil fuel producers and cement companies, the top 20 of which you can see in front of you here. And so for example, 2 individual corporations, Saudi Aramco and Chevron, are each responsible for at least 3% of cumulative global industrial greenhouse gas emissions since 1750. Okay, so these corporations are large emitters of greenhouse gases, and many of them are publicly owned. Second reason to focus on what big corporations are doing on climate change is that they're politically influential, and their lobbying activities can shape public policy. So, for example, the think tank Influence Map does a lot of great work to monitor the lobbying activities of big corporations on climate change, and has documented a number of cases worldwide where regulatory proposals have been weakened in one way or another by corporate lobbying activities. For instance, the technical details of emissions trading systems, shipping regulations, vehicle emissions regulations, electricity and clean power policies, carbon taxes, aviation regulations, and so on. Now, of course, big corporations get involved in lobbying in order to protect their own interests, but I raise this as a separate issue because they're not just protecting their own interests here, they're actually affecting the emissions of other companies through their lobbying activities. And the third reason why big corporations are increasingly under the spotlight on climate change really stems from the relatively slow pace of nation-state level action on climate change. So I'm sure that you're all well aware of this. Countries have been cooperating with each other on climate change formally since at least the early 1990s. And really we have very little to show for it so far, which has fed into a frustration with a process centered around nation states. And whatever you think about it, it has led to a shift in focus towards so-called non-state actors, of which corporations are one of the principal examples. So this is, if you could think about this in the context of second best policy. So in a vacuum created by the absence of sufficient state level action in certain countries, particularly, actors who are trying to push climate action have turned their focus away from governments and towards non-state actors like grassroots organizations, investors, companies in the real economy, cities, and so on. And big corporations are very much part of this movement. So I think that's one of the main reasons why there's so much interest in what big corporations are doing on climate change these days. So having motivated the interest in big corporations' climate action, the next question to ask is, okay, well, how are we going to measure corporations' climate actions? How are we going to establish, how are we going to differentiate good companies from bad companies, if you want to put it like that? Well, this is difficult. There are lots of challenges here. One of the biggest difficulties is that most of the information that we or anybody else in this space has on corporate climate action is provided voluntarily by the companies themselves. For example, through their corporate social responsibility reports, their sustainability reports, perhaps their annual reports, in some cases, responses to questionnaires. You may be aware of the CDP questionnaire. Some people might use the results of the CDP questionnaire for the research, company websites, and so on. Now, I'm not saying that there is no information on companies out there which is provided under a mandatory disclosure regime. There is some of that. It is, for instance, possible to piece together the emissions of some companies by adding together entity-level emissions data under the EU emissions trading system. And that might give you, for some companies that operate solely in the EU, a good picture of their operational emissions. But in the universe of public companies, most of them are not providing information through mandatory disclosure regimes. And even for those that are covered by carbon regulation, like emissions trading systems, typically you will only see their operational emissions this way and not get a picture of emissions up and down the value chain. And the fact that most information provision is voluntary creates a number of problems. The way companies provide information on their climate actions is rarely standardized. And that is despite the existence of some important frameworks for climate reporting that are actually widely agreed upon in industry, such as the GHG protocol, from which concepts like scope 1, 2, and 3 emissions come from. But despite the existence of important and widely agreed upon guidelines for corporate climate reporting, companies still enjoy a lot of latitude in what to disclose. For example, they can choose their organizational boundaries for reporting their emissions. They can choose what kinds of activities to include. They can choose, to an extent, how they measure their emissions and what performance metrics they report. And this makes it hard to compare companies. Even if companies were disclosing information entirely in good faith, one has the difficulty of comparing for example, emissions disclosed on different bases with different boundaries and so on. And the question of whether companies are actually disclosing information in good faith can also be questioned. So the fact that disclosure is voluntary does leave open the possibility that companies disclose strategically. And if you take it to its limit, there is the particular worry about greenwash. In other words, companies presenting themselves as being more green than they actually are. Okay. So these are the challenges that exist in this space that we have to overcome. In terms of the types of corporate climate action that we could try to measure, I might tentatively suggest that we could organize the types of action into three categories. So the first is we might call governance or management practices. So the kinds of things that we might test for here include, well, does the company have some kind of stated climate change policy? Does it disclose its emissions? Yes or no? We'll put to one side for a moment the details of the emissions disclosure and how we might assess that. Does the company have emissions targets? Has it allocated board responsibility for climate change? Is someone on the board responsible for climate change? Is there a committee of the board responsible for climate change? Taking that a step further, is executive pay tied to climate KPIs, such as the achievement of emissions reduction targets? These are the kinds of questions that one might ask if one were judging how a company governs or manages climate change. And this is the traditional preserve of ESG data, so environmental, social, and governance data. So some of you might work with ESG data, and a lot of that is put together in this way by testing for the existence of certain management practices. It also links with a fine tradition in say economics research for looking at how well companies are run by establishing a set of actions that you measure whether they have implemented them or not. But it's clearly only an input measure. It's not what ultimately matters. It might be indicative of a company's ability to make a low carbon transition or be competitive in a low carbon economy, but it's not what ultimately matters. So the second category of corporate climate actions that we could try to measure include things associated with operational and capital expenditure. So for instance, if one is looking at the automobile manufacturing sector, then a useful metric might be spending on electric vehicles. Conversely, if one is looking at oil and gas companies, then it's widely agreed that an important measure of their willingness to adapt to the low carbon transition is how much money they're spending on new oil and gas exploration, so exploration capex. Okay, so these kind of measures are indicative of where a company is heading. And then the third category is the thing that ultimately matters, the eventual outcome of all of this, which is companies' emissions or their emissions intensity, and perhaps some other outcome measures that might be interesting. For example, there's a lot of interest right nowadays in clean technology patents as an indicator of a company's positioning in the transition to a low carbon economy. Although it won't be in the interests of all companies to be the innovators, some companies may operate a perfectly good business model licensing other companies' innovations. Now, just to explain where our research fits into this, what I'm going to be talking to you about for the rest of my talk today primarily falls into the first and third categories. So I'm going to show you data on corporations' climate action in terms of their governance and management practices. And then I'm going to show you data on corporate climate action in terms of emissions and emissions intensity. And this is partly because these are the things that are relatively easier to measure. And also because there are some quite significant challenges, particularly in the second category around OPEX and CAPEX of characterizing generically across sectors in the economy what low carbon OPEX and CAPEX actually looks like. So let me go on to the next part of my talk, where I'm actually going to show you data on, roughly speaking, the state of corporate climate action today. What are big corporations doing on climate change? And the data that I'm going to show you comes from a research project we've run at the LSE since 2017 called the Transition Pathway Initiative, or TPI. Now, this is possibly quite interesting as a university research project in that it is actually sort of run by a group of institutional investors, primarily asset owners, pension funds, as well as some asset managers. The TPI currently has more than 100 supporters, and in principle, they wield a lot of influence. So they have about $30 trillion of combined assets under management and advice. And so if they were to be changing their investment allocation based on our data, and I'm by no means claiming that they are doing that to a large degree, but if they were, then that would potentially shift a lot of capital. But they also use the data not only for their investment choices, but also for investor engagement with companies. And the heart of TPI is a database, which is the result, the contents of which I'm going to show you this morning. So we assess companies' progress on the transition to a low carbon economy. And we do that by scouring publicly available sources on each company and populating an assessment framework on that basis. And all of our data and all of our methodologies, in fact, are available open access on our website. So you can pick through the data if it interests you. And you should, moreover, be able to replicate the numbers because we publish all the methodologies as well. So about the data set, well, it's not an enormous data set. So we currently cover 400 companies in 16 sectors. Of course, the universe of public companies it runs into tens of thousands. But we focused on the biggest companies by market value in the highest emitting sectors. And so in that way, this sample of 400 companies punches above its weight in terms of global emissions. And if you think back to the slide I showed you at the very beginning about the historical contribution of just 90 fossil fuel companies and cement producers, then you can see how very quickly you can capture a large share of global emissions just looking at a relatively small set of companies. So, as I mentioned, we prioritize the largest emitting sectors, for example, electricity and oil and gas. Within each sector, we sort public companies by their free float market capitalization. So we're capturing the biggest companies in terms of market value. That's because they're the most important companies to investors. And we throw in a few companies, additional companies that are of particular interest to investors. So it's not a random sample. It's quite important to point out that as I've tried to argue to you, that it's an important sample. So I would say that within the sectors that we're looking at, pretty much all the big companies you could think of are in there, as long as they are listed companies that are significantly financed through equity, rather than, say, being a big company that is mainly debt financed. So this is the framework that we use for analyzing companies' governance or management practices. What you can see here is a set of 19 practices or indicators, ranging from the most basic ones, like does the company have a climate change policy in place, through to things that are indicative of a company that has a much more strategic take on climate change. For example, does it use internal carbon pricing in order to do capital budgeting? Does it do some kind of scenario planning to think about its future strategy in the context of climate change? So we have these 19 practices, and we sort them onto 5 steps of a staircase. Conceptually, the idea here is that companies start by signaling their recognition of the problem, then undertake a series of largely operational steps to get a handle on their emissions and try to start reducing them, and end up with a set of more strategic actions. And the steps are not crucial here. You can take these indicators out of the staircase and organize them in different ways, as we have done from time to time. But investors find this to be, at least to be a simple way of organizing the data so that they could actually, for example, integrate these data into their investment portfolio allocation. So each company gets scored 0 or 1, no or yes on each of these 19 indicators. And in order for a company to progress up a step on the staircase, they have to satisfy all the indicators on the previous steps, if you see what I mean. That's the progression rule. And so at the moment, for our universe of 401 companies, these are how the data look. So this is one take on the state of corporate climate action. So you can see here that about 40% of companies are on levels 0, 1, or 2. What that means is that these companies have failed to do one of 4 basic things. Either they don't have a climate change policy, or they don't explicitly recognize climate change as a business risk or opportunity, or they don't disclose their operational, or in other words, scope 1 and 2 emissions, or they don't have any kind of emissions reduction target, even some kind of qualitative target in place. So about 40% of companies are on levels 0 to 2, and they are lacking basic steps. The remaining just over 60% of companies are on levels 3 and 4. That means that they've done those 4 basic steps that I've just mentioned, and most of them have implemented a wider range of practices as well, including disclosing more widely on their value chain emissions, allocating board responsibility, setting long-term quantitative targets, and so on. 14 companies in total satisfy all 19 of the indicators. On a sector level, the top sectors are electricity, diversified mining. That's quite a small set of big global companies that are engaged in diversified mining activities, and chemicals. The worst sectors are pure play coal mining companies and shipping companies. Now, here I unpick the data on an indicator by indicator level. So what you've got here are the 19 indicators listed from top to bottom. The share of companies that satisfy the indicator is in blue. And you can see here something that we would expect, which is that the vast majority of companies have implemented basic carbon management practices like having a climate change policy and so on. Relatively few companies have implemented the more strategic practices. Of course, this is how we design the staircase. So in a way, this is almost just validates the structure of the staircase, but it also does generate some interesting insights, I think. One thing I'll draw to your attention is that 79% of companies disclose their scope 1 and 2 emissions. Now that's encouraging, but in terms of, if you're into climate finance and you're thinking about really important questions like, are transition risks priced into markets, then I would observe that 21% of these companies are not providing the market with any information about their carbon footprint, which does actually strike me as being quite a lot, considering that these are the world's biggest emitters. A couple of other interesting points I would suggest to you. One is that among the things that companies are relatively good at, considering that we think of them as being more strategic, companies are relatively good at setting targets, and they're relatively good at thinking about climate change as a risk management problem. Conversely, companies are relatively weak at a series of indicators which are basically clustered around the public policy interface. So, for example, we ask companies whether they're open about their involvement in trade associations that are active in climate change lobbying. And we further ask them whether they have any procedures and policies in place that could deal with inconsistencies between their own climate change position and the position of lobby groups that they're members of. And relatively few companies are able to satisfy these indicators. Okay. I'll give you an example of why this is important. A number of leading oil and gas companies have made quite ambitious announcements on their long-term strategy to decarbonize. But on the other hand, they remain members of industry lobby groups that are actively trying to undermine climate regulation. So that's why we take an interest in these questions. Another thing we can look at is trends. So what I'm showing you here is year-on-year changes, 2020 to 2021. So the blue bands represent companies that stayed on the same level in 2020. That's on the left, in 2021. That's on the right. The green bands represent companies that are moving up at least one level. The red bands represent companies that are moving down at least one level. So we have trend data on 328 companies. The remainder of the data set was newly added last year. 69% stayed on the same level. 17% moved up at least one level, and 14% moved down at least one level. So really the main point here is that there is some progress on aggregate, but it's very slow. And we've been updating this database. Well, we've done 4 updates. And this is what we see every year. We see progress, but it's very slow in terms of corporate carbon governance and management. We particularly see progress at the lower levels. So we see companies implementing these basic steps I described to you before around establishing climate change policies, starting to disclose their operational emissions and so on. At the higher levels, we tend to see this movement up and down. And I think that some of this is genuine, but I'll be open with you. I think some of this is also a measurement problem. If you are using companies' disclosures to try to work out what they're doing on climate change, and companies don't remember to disclose key information every year, then they can move down a level as an artifact. Of course, from an investment point of view, one does want these companies to keep consistently disclosing the same information. But it is possible that in some of these cases, companies don't feel like they need to disclose the same information about their governance arrangements 2 years in a row. And if you're using disclosures to score them, then that could lead them to lose status. Okay, so much for corporate carbon governance. What I want to talk about now is emissions. So one of the questions that we are asked most often is, how ambitious are corporations' climate targets? And the technique that we use to compare companies' carbon emissions and to work out how ambitious their targets are is something called the sectoral decarbonisation approach, which was outlined in a paper a few years ago in Nature Climate Change by a research team. The first author was Oscar Krabbe. And there are 2 important features of this methodology. The first one is it works with emissions intensity, so emissions per unit of activity. And of course, the reason for doing that is if you're going to compare companies, you really need to normalize for company size. Otherwise, you don't learn very much. The other feature of this approach, as the name suggests, is it is a sector-by-sector approach. Basically recognizes that the economics of decarbonisation is different in different sectors. including where emissions are concentrated. So how much is operational versus up and down the value chain, and also how costly it is to reduce emissions. As an aside, a lot of data sets of corporate climate action will calculate something like emissions per dollar of revenue, and they'll be able to do that for tens of thousands of companies. But of course, what happens when you do that is that, and you make comparisons across sectors, you will find that such things as tech companies have very high revenue per ton of carbon, or very low emissions per dollar of revenue, and fossil fuel companies will have very high emissions per dollar of revenue. But the question is, how useful actually is that comparison? Some investment strategies based on emissions per dollar of revenue across the whole economy will essentially lead to shedding fossil fuel companies and acquiring tech companies, which may or may not be a good idea from an investment point of view, but it has been questioned whether this will actually deliver emissions reductions in the economy, or simply lead investors to shedding dirty companies that will be acquired by other investors who care less. So I think one of the advantages of this approach is it takes seriously that the challenges vary by sector, and we don't try to compare different sectors. What we do is we take each sector and we try to establish good companies and bad companies. Now, using an emissions intensity approach from a climate change point of view creates an immediate problem. And the problem is this: climate science tells us that absolute emissions matter, not emissions intensity. The way this approach gets around that problem is it takes an absolute carbon budget, divides it into sectoral carbon budgets, and then converts sectoral absolute carbon budgets into sectoral intensity pathways by dividing emissions by sectoral activity. And you do this using an energy systems model, for example, the IEA's model. That gives you some low carbon scenarios or benchmarks against which you can overlay company emissions intensity pathways, both historic and forward-looking, based on company targets. And that is essentially the way of judging whether a company is aligned with international climate goals, such as the Paris goals. So let me show you some data on putting this approach into operation. So the first sector I'm going to show you is electricity. So this is actually a screen capture from our online tool. I've picked the top 10 largest emitting electricity utilities in Europe and Central Asia. The performance metric in electricity is quite straightforward. It's carbon emissions per megawatt hour of electricity generation. You can see the company's pathways overlaid on the low carbon scenario benchmarks. The solid lines are the historical data. The dotted lines are the future pathway implied by the targets, and the aim is to get all the companies under the benchmarks as quickly as possible. I show you electricity because it's a sector that's quite well aligned, relatively speaking. It started decarbonizing quite early. It's relatively easy technologically to decarbonize. It's also a sector that is somewhat heterogeneous. So there's quite a spread between companies here based on which ones are operating fossil fuel assets and which ones are not. You can contrast that with cement. This is cement. The broad brushes of the method are just the same. The performance metric here is CO2 emissions per ton of cementitious product. In contrast to electricity, cement is quite widely recognized as a sort of hard to decarbonize sector. It's also quite a homogeneous sector in terms of production technology. So you see the big European companies here clustered around an emissions intensity of 0.6 tons of CO2 per ton of cementitious product. And everything therefore hinges on the company's degree of ambition for the future in in terms of their emissions reduction targets and whether they can deliver on them. The last example I want to show you is oil and gas. So here, the performance metric is not obvious because decarbonization is a sort of existential threat for oil and gas. Our performance metric is greenhouse gas emissions per megajoule of energy supplied. The idea here really follows from what some of the European oil and gas majors are doing, which is setting out a long-term strategy to turn into low-carbon energy suppliers rather than specifically supplying energy from oil and gas. You can see that all the big European companies start with an emissions intensity which is higher than the emissions intensity of the overall energy system. But some of those companies, for example, Royal Dutch Shell, Total, and so on, have set targets that would see them significantly reducing their emissions intensity. Yet we find that those targets are not ambitious enough to claim to be aligned with the Paris temperature goals. Overall, across all of the companies in our database where we apply this method, we can test for alignment with the UN temperature goals, and this is what we find. So it obviously depends on which year you pick or which horizon you pick, but whether it's 2030 or 2050, the data look pretty similar. We're looking at about 2/3 of companies either not providing any disclosure or unsuitable disclosure or just not being aligned with the Paris goals. About 1/3 of companies being aligned with the Paris goals in one form or another, but only about 15 to 20% of companies being actually aligned with 2 degrees or below. Many of the companies have targets which are consistent with country pledges to the 2015 Paris Agreement, but we know that that's not enough to hit the Paris Agreement's temperature targets. So just want to, so obviously for many sectors, the key factor in determining whether a company aligns or not with the UN climate goals is how ambitious their targets are. So I want to finish with a few slides addressing companies' emissions targets specifically. So you might be familiar with what I've called here the net zero target craze. So according to some recent research by Oxford University and others, of the world's 2,000 largest public companies, 21% now have so-called net zero commitments. In other words, they're presenting their emissions targets as being net zero carbon at some point in the future. Well, that is encouraging because clearly the number of companies with net zero targets has increased a lot in the last year or two. But it's important to realize that these often cover a limited scope of companies' life cycle emissions. So for example, in auto manufacturing and in oil and gas, we see a lot of targets to reduce scope 1 and 2 or operational emissions to net zero, but don't do necessarily anything about companies' downstream emissions from use of their sold products, which for sectors like autos and oil and gas is where the larger part of the life cycle emissions are concentrated. So a net zero target announced by a corporation does not necessarily mean that a company's material emissions, if you want to put it like that, reach net zero. We counted in our database how many companies have a sort of material or genuine net zero target, and we find that it's only 12%. On a positive note, this is much higher than last year. Another encouraging thing is that company targets are becoming increasingly long-term. So what I'm showing you here is the average, the kind of unweighted average target year of companies' climate targets as measured in each of the last 4 years in our database. Now, of course, time is passing. And so we would, as a matter of fact, hope that at least every additional year, we assess companies that the target year moves out by 1 year. But what we find is that companies' average target year is moving forward faster than that. So companies are setting increasingly long-term targets, with 2030 and 2050 often being focal points. 2050 driven by climate science, really, and the need to have net zero CO2 emissions in 2050. Are companies on track to hit their targets? Well, in most sectors, companies are not reducing their emissions fast enough to hit even their 2030 targets. And in no sector are companies reducing their emissions fast enough to meet their 2050 targets. So in essence, companies are procrastinating. They're backloading their efforts to later years. And perhaps interestingly, we find that companies with targets have reduced their emissions slightly faster than companies without targets. So you can question whether how important targets are as a measure of truly what companies are doing on climate change. But this evidence suggests that actually targets might be indicative of how seriously companies are taking the problem. So let me sum up. I think I've got a few minutes left. I just want to summarize what I have talked to you about this morning, and then I would be very pleased to have a discussion about the issues that I've raised. So some conclusions from our analysis. So most big corporations now have basic carbon governance and management practices in place. So sort of presentationally, they can show themselves to be aware of the problem and to have some carbon governance in place. But relatively few companies can demonstrate a truly strategic approach to the issue. We see slow progress year on year in the implementation of carbon governance management practices. Every time we've constructed one of these Sankey diagrams, like the one I showed you earlier, we see pretty much the same thing. Most companies staying still, more companies moving up than moving down, but still relatively little progress on aggregate. Despite the proliferation of targets and net zero targets, according to the method we use, we would say that most companies are not aligned with the UN climate goals, either now or in the future. However, I want to perhaps uncharacteristically end on a positive note. We do see encouraging trends, including an increase in the number of net zero targets, which we might call genuine or material, and an increasing propensity to set more long-term emissions targets. Okay, so that is the end of my talk. Thank you so much for listening. I'm going to stop sharing my screen now, and I'll be happy to take questions. Thank you.
Well, thank you, Simon, for this wonderful talk with quite a few sort of interesting insights. Maybe I start with a little comment on that. Today I read a little report that in their financial statements, companies, about 70% of the companies omit information on their financial risks, and the accountants don't even sort of recognize that. So it's a number that is in the order of the numbers you reported. And I find that very disturbing as well. Okay, but before I go on, we already have a question coming from another side. I'm not sure, this is Runtian Feng has in the Q&A asked a question. Runtian, do you want to come up here and ask a question live, or should I read it? I think there is some movement. We can't hear you. Okay, maybe I read the question. Okay, so the question is, so far we are mainly talking from carbon and carbon reduction. Is it also interesting to see what are big corporations doing in investing in cleaner technologies or green bonds, etc.?
Yes, it's a very good question, and yes, absolutely it is, and I think particularly where you are doing a deep dive on a company or a small set of companies, it's important to understand what they're doing in terms of clean tech investment. I think really the reason why we don't currently track those data is that when you're trying to construct a reasonably large data set, and a data set which spans some quite diverse sectors in terms of what they produce and what technologies they use, it can be quite hard to develop practicable measures of this kind of thing, which is why we tend to focus on the two legs of the tripod on either side, the kind of basic governance and managerial story on the one hand, and the carbon and carbon emissions story on the other. So it's, if anything, it's really a question of expediency here.
All right. We have I can see at least Christoph. We seem to have a few other raised hands, which I cannot see, but Christian, our technical supporting guy, who I want to thank at that point in time for setting all this up, will make for them also available to ask questions. So, but now let's go to Christoph.
Okay, thank you. Well, thanks, Simon, for that very interesting and very, I would not say provocative, but giving a lot of food to think, and especially when, as I have been doing for years, thinking about what are useful ways forward. On a practical side, I have a detail that I was wondering about. In your example one, you are at least virtually, as Rüdiger explained in the beginning, in Europe's, or at least Germany's, energy capital. And there's one large company known as one of the largest polluters in Germany, which I have not seen in your example one. That's RWE. Do you have any idea why it doesn't pop up there?
Well, we do cover RWE, and in a moment, let me say something about why RWE is a really good example of why I think this method is useful. Why did it not pop up? That I don't know. Is it? It could be due to its capital structure potentially, and the extent to which the size of its free float market cap relative to some of these other companies. I don't know. That's how they're ranked. So either that, or
compared to PGE and GEZ, I don't know exactly their capital structure, but basically I would expect that those are also larger in free float.
Yes, so it could be a bug. It's there. If I may, I'll give you an anecdote which I think shows why this approach is useful. So RWE has a long-term commitment to decarbonize, as I understand it. Currently sits on significant fossil fuel assets, coal generation. So because it has a long-term, an objective to hit net zero carbon, I think in the mid-2030s, if I'm right. Something like 2035, I think. I could be wrong in the detail.
2040 in mind, but
okay. So it's you can argue it's aligned with the UN climate goals because it's got a long-term strategy to reduce its emissions to net zero about the time when the electricity sector needs to do that. However, a lot of investors are under pressure from stakeholders to divest from RWE immediately, because since it operates coal power plants, it falls foul of typical investor exclusion policies. So investors are asset managers are being instructed, or asset owners are under pressure to say, no fossil fuels in the investment portfolio. So they have to divest from companies like RWE. I would argue that that's potentially the wrong message, because it's too simplistic an investment strategy. Better to look at not at what sector companies are in or what their emissions are right now, but also on what their plans are to make the transition. So our recommendation we don't make recommendations, but the implication of our data is that one should not divest from companies like RWE, which are dirty right now, but have plans to change.
Oh, I think that the RWE persons in charge are very happy to hear that you are recommending that. Okay, but I have other questions, but I see Abuza has also raised his hand.
Yeah, maybe we have Abuza in between.
Yeah, so my name is Abuza. Thank you very much for your informative presentation. So I just have a question regarding the future. So moving on, do you foresee so because as you said, the companies, do their reports voluntarily, and they set their climate targets. So do you see an incentive or a carrot and stick policy to hold them to their words moving on if they, do not match their targets? Or how do you see if there can be a policy which can be proposed by any state institution or any societal organization to hold them to their words or their targets? Any mechanism?
Yes, a really interesting question. Thank you for that. And it's a natural question to ask, because we're not just interested in companies' targets, we're interested in having them deliver on them. It's not completely straightforward to answer, but I can see two ways that people are trying to deal with this problem. One is that actually when companies set targets, and particularly when companies set formal targets, they do leave themselves open to being litigated if they fail to achieve them, which is actually why some companies don't call them targets, they call them ambitions. If you see a company that has low carbon, quote, ambitions, unquote, the reason for that is they're worried that they're going to get litigated for missing them. So one tool for forcing companies to deliver on their targets is litigation. Linked to this, one of the reasons why people are very interested in whether executive pay is linked to achieving emissions targets is this issue. That's another way of being more confident that targets will be delivered. Is do big executives does their pay get linked to achieving these targets? The entirely separate way that people are trying to get around this problem really gets back to, I think, the first question that was put to me, that people are trying to develop metrics related to things like OPEX and CAPEX, which are actually perhaps able to dig under the surface of the target and look at whether companies are actually doing things on the ground which would be consistent with them. So these are, I think, some of the ways that people are trying to address this issue, but it's not an easy issue to address.
All right, thank you. I think Christoph had another question, or am I wrong? Oh, right.
Yeah, well, I'm wondering, you base your selection on market capitalization or free float. Looking at some aggregate financial data, I get the impression that the US companies are far overrepresented in terms of global market capitalization than other parts of the world, including Germany. Probably for the UK, they are closer to. If you would make a ratio of GDP to market capitalization, I haven't concluded it, but I'm quite sure that the US companies have a much higher market capitalization in ratio to GDP than European countries, or even more Chinese or Russian companies. Do you see any possibility to extend your method also to non-market quoted companies?
Yes. Well, firstly, you're right, I think. I haven't analyzed this, but I certainly, if you look at the electricity sector, we have a lot of US electric utilities in our data set, and I think that reflects this phenomenon. The investors that support us are global. We have investors supporting us in Europe, but also in the US, in Australasia and Asia. So they are sort of, free float market cap was the simplest single metric that we could use to establish, what are the importance of these companies for the kind of the average investor who has a global equity portfolio. We are this autumn, we will be for the first time adding a set of companies which are large emitters, but are primarily or exclusively debt financed. So a number of private companies that are big emitters, including obviously some of the big oil and gas producers like Pemex are private companies. State-owned companies is a different question. So we are moving that way. And of course, as we expand the data set, we hope to roughly double the size of the data set over the coming 2-3 years. We should be going deeper into the sector in outside of North America.
All right.
Yeah, I think it's a very good data set, but in terms of global strategy, achieving Paris pledges or 2 centigrade objectives, it's important also to have metrics for the other companies. And now I remember how I came to that conclusion that North America is overrepresented. As a private investor, I have had some takes in an ETF based on MSCI, and then you look how this MSCI index is, what the share of the US is in the overall index weight, then it's more than 50%.
Yeah, so if I may just make a further comment on this general issue. So there's basically a quality quantity trade-off with providing these kinds of data. And that trade-off exists in large part because of the non-standardized nature of it. There are data sets available, such as MSCI data, which are, now I'm not going to say they're low quality, but they certainly are high quantity, right? So you can get data from these providers, which basically covers the whole of the investable universe. But in order to provide comparable data on, say, 40,000 companies, you basically have to use algorithms, right? So our emphasis is a bit more on quality. So for example, let me take oil and gas as an example. So most of the life cycle emissions of an oil and gas company are downstream. They fall into the category of use of sold products, right? Only about half of the top 50 oil and gas companies actually disclose this information. So the only way to construct a measure of life cycle emissions intensity for oil and gas companies is actually to extract from these companies' annual reports their energy sales, and then convert the sales of a series of segmented products like bitumen, natural gas, LPG, into carbon and energy equivalents. So you can see how doing one company will take one of my team a day. And therefore, then you end up with you're talking about being able to do hundreds of companies, not thousands, let alone tens of thousands. So there's this kind of, I think we're speaking about this basic kind of quality quantity trade-off in corporate climate data.
And maybe I can comment on that as well. We did a rather large empirical study on carbon disclosure data from companies, and we had a a quantity, but what we saw is many of them are not synchronized. So if you calculate carbon intensity, you may have different emission disclosure dates to sort of the dates where we would use as a denominator of that. So that was one of the major sources of failure or making the data unreliable. Well, anyway, just a comment. We almost perfect in time. So if there's nobody else whom I can't see who wants to raise a question, I don't think so. Kristen is not signaling anything. So then it's my pleasure to thank you again, Simon. You delivered a very high quality talk. It's a very, very good start in our conference. And thank you so much for joining us and being here. And well, it was a pleasure as always. So we now have a lunch break until around 1 o'clock. The virtual conference rooms are open from 10 to 1 on, and then we have two streams on demand response, and the other stream will be on trading. I'm looking forward to well, see many of you in these streams, at least with an icon. And I'll yeah, look forward to the remaining days of the conference. Thank you very much.